Welcome to Economics Explored Live. It's Saturday, the 30th of October 2021 here in Australia, and it's the 29th of October in other parts of the world, including in Milwaukee, Wisconsin, USA, where Darren Brady Nelson is joining me from. Darren, good to have you on the show.
Thank you for having me back.
Oh, pleasure, Darren. Now, I'm keen to chat with you today about inflation. That's been in the news here in Australia this week because we've had the new CPI data that's come out from the ABS, and people are getting excited by the fact that the core inflation measure that's published by the ABS, that's gone into the RBA's target band of 2 to 3%. So there's a bit of, anxiety, and there's speculation about what that might mean for future interest rates and monetary policy. So there's a lot of discussion about that. Now, you've recently written an article that's taking a bit more of a longer term perspective on inflation, and so it'd be good to chat with you about that. And you're looking at getting that published somewhere soon in one of the local Aussie journals, and your paper is called RBA, the Inflation Buck Stops Here. The Reserve Bank of Australia doesn't fight inflation, it manufactures and maintains it. This is a quote from the 2011 book, The Evil Princes of Martin Place. Fascinating. I haven't read that book, Darren. Where should we begin? Can you tell us what you're arguing in this article of yours, please?
Yeah. So look, I've actually wrote a similar article, although I'm always thinking of different ways of kind of putting the issue. I wrote something for a U.S. market, about their inflation and CPI figures in the middle of the year. I thought, and I've been talking to many people go like, oh, yeah, you should do that for Australia. So I did. So it's basically, I'm kind of doing a little bit of an inflation 101. So I'm not getting into too much of, some of the detail that gets argued and discussed between economists and commentators. So in the article, I'm starting out, obviously with a provocative sort of opening line. But it is, as it goes on to say a bit later in that paragraph, it talks about that I use that in an article, my first article when I spoke about inflation, which was actually in an Australian context. So, I kind of look at sort of what are the latest statistics, particularly CPI, of course, the one that most people look at, looking kind of recent years, and there you can kind of see kind of the more recent trends, looking at the percentage change, the inflation rate, if you like, although as I get into the article later, I explain that, that's not actually inflation. But anyway, this CPI percentage, as it's changing over time. But I quickly also put next to that, okay, well, let's look at the CPI index itself over a long stretch of time. In fact, I think in my piece, I actually maybe used, I think whatever the longest time frame that, for instance, the ABS, from when the ABS first started to actually put out the statistic of CPI, because you kind of need to see both. And for me, actually, the main point of my article is more closer to that sort of that long-term trend of what CPI has been doing than although I certainly have things to say about what's been happening, particularly the past 2 years and I guess this year in particular. And then sort of like I use that as a jumping off point, the Aussie statistics to kind of just give kind of a bit of the economics behind what inflation is. I quote from 3 different schools of thought, 3 leaders from 3 different schools of thought. Ludwig von Mises, Austrian, Milton Friedman, Chicago, and John Maynard Keynes, Keynesian. And then I jump back in after I kind of explain, and we can go into some of this in detail. So I basically put forward the proposition that, inflation isn't, basically the rise of prices isn't caused by a rise of prices. It's caused by something. And that something is the rise in money supply, given the state of demand for money, of course. And then, so I jump into a bit of the economics of that. I jump back into the statistics where I then, because I've obviously said, hey, this is the money supply is kind of the key thing to look at, along with obviously starting out with not just CPI, but some of the other sort of pricing statistics out there, about producer prices and various other things, to start looking at sort of the key money supply statistics, which the Reserve Bank is the keeper of those statistics, and and then sort of lay out what M0 is and M1 and M3, and then kind of replicate again kind of a shorter term view of what that looks like, and then also juxtapose that with the very long term view. I think RBA has been putting out statistics since I think the mid '60s, so not as long as the ABS has been doing CPI, but still quite a long period of time. And then I jumped back into some economics that, even though I'm quoting another Austrian economist, I would hope that you're sorry about that. Did you hear that, Gene?
No, what happened?
Siri just jumped in.
Did it?
I apologize. Siri thought I was talking to Siri.
Siri was trying to track down an Austrian economist for you.
Well, CPI, actually the word CPI that's what activated Siri. I guess Siri's very interested in CPI. So then I would hope, even as a non-Austrian, you're kind of a more mainstream economist, I guess. But I hope those three sort of like economics demand and supply curves would get you excited. They're very basic. Obviously my audience isn't supposed to be economists as such, but I think these charts are so basic that I think even a non-economist can kind of get a feel for what's going on. Basically I'm getting some charts from Murray Rothbard and his famous book, The Mystery of Banking. And he explains he brings into the concept that obviously economists mentioned too, which is inflationary expectations as well. So, yes, even Austrians do factor in expectations and not just money supply. And then finish up with, if you like, some policy sort of thoughts in the paper. So sorry for that sort of long-winded introduction or overview of my article.
No, that's all good. Darren, I brought up the site Trading Economics. I mean, would you like to show charts, or are you happy for me to track them down? I can search for them and then just flash them up on the screen. Is there a chart that you'd like to show?
Yeah, look, might as well put up, start out with the charts that I actually, have in my article, which will hopefully be published in one of the Australian publications. Probably, I guess it'll be next week, I suppose. So, yeah, there's unless you want me to do that, I probably can find it a bit quicker since I know the specific charts I'm looking for.
That'd be good if you could. So
yeah. So bear with us, audience. There might be some technical difficulties, but hopefully not.
Yeah, this is the first time we're trying the StreamYard platform together. I find it works reasonably well. But I haven't done one where I've had a guest on and trying to get them to show the screen. So we'll see how we go.
I might be having some technical difficulties. Firefox is wanting me to do all sorts of various things. Grant access to this application.
Right.
Have you seen that before?
No, I use Chrome. Let me just see. I'll see if I can. CPI inflation Australia. See if I can just.
Yeah, it's called. Yeah, sorry about that.
That's okay. I've got it up. I've got one of them up here, Darren. I will. I'll share my screen. Okay, share. Okay, can you see that, Darren? That's basically the chart of the Australian CPI, and from the
that's oh, is that that's the very long term one.
Yes.
Probably start out with the basically the percentage change one, which is
that inflation rate? That one there, Australian inflation rate.
Scroll. I think it's inflation rate. Yeah, and then
Yeah.
if you put it to 10 years, that'll give you a little bit better perspective. Yeah, that's exactly the one. So that's basically the one I'm using. Or start out with that one. Look, you can, and as I point out in my article, look, yes, this correlates with some of this, obviously the very unusual things that have been happening in the past 2 years. But also one of the unusual things that's been happening in the past 2 years is, if you like, the cranking up of the printing press even more than what the Reserve Bank has done in the past. And the Reserve Bank, as I've pointed out in previous articles, has been running, things along the lines of quantitative easing before they even said they were doing something like that, right? So I'll give the Federal Reserve credit for saying, hey, we're about to do quantitative easing, and then they did it. The Reserve Bank was far more stealthy about it, which is obviously a bit of a different issue.
Well, it wasn't an explicit quantitative easing policy where they were printing money or electronically creating it out of thin air and buying long-term government bonds. So they didn't have an explicit policy such as the Fed, as you mentioned, or the EU, the bank, the European Union Bank, or whatever it is, ECB,
ECB,
or Bank of Japan. So
Bank of England.
It's the pandemic that's led them to do this, and we've seen really strong growth in Aussie money supply. Is that something you'd like to have a look at now, Darren? I mean, you've shown that CPI has gone up to the rate of CPI has accelerated to
as you can see,
3 to 4%. That's the headline rate. The core rate's up around 2 to.
Yeah, and it's higher than, obviously, within, you can see in that 10-year range, it's gone up to levels higher than that's been seen in that particular range. But then, I jump immediately to go look, I think the index itself, although it's certainly fine to look at the percentage change and how it's moving over time, and that's a legitimate thing to look at. But I think the most revealing thing, particularly for the sort of the narrative that I'm trying to sort of expose people to, if you like, is, the index itself, particularly over the maximum range. And obviously you can look at it in smaller ranges quite easily using trading economics. But you can see the story of, Aussie inflation has been going since the mid-'70s. There's a little bit of a flattening out during, if you like, the heyday of microeconomic and other sorts of good reforms in Australia, sort of the late 80s into the 90s. You can see, and that's no coincidence, that helps, even if you're printing more money, even if the Reserve Bank, didn't lay off much in the 90s on money printing, at least you had reforms that were, sort of pro-productivity that increased competition, et cetera, that obviously will put downward pressure on prices. As you can see, didn't send prices to actually deflate as such, but that was a pretty good, you and I were both around for that time period, and we certainly remember it as a particularly good time period in terms of economic reforms and wealth creation, et cetera, in Australia. Then I jump a bit later in my article, so we might as well jump to those money supply statistics. As you can see below, under health is money to the right.
Yeah. Okay. So which one would you like to look at first? M0?
Oh, no. Just if you scroll down, you don't have to. Just go to the right side. See money?
Money. Oh, gotcha. Yeah. Oh, that's
open
clever.
It up, and then just go to M0 to start out with.
M0, right. So, okay, M0, money supply. Right. So that's what's happened. Yeah, this is the result of all of the quantitative easing that's been occurring.
Right. Yeah, and I'll try to, in my article, I sort of I use the words of the Reserve Bank, so I don't want to be sort of so that I'm not making up what these definitions of M0 and M1 and M3, those are kind of the three main ones that they use. M0 is notes and coins, plus deposits, plus the RBA's deposits at banks. That's in a nutshell what M0 is. Then M1 is adding on top of M0. It takes what M0 already has, then it adds in transaction deposits with banks essentially, and then M3 takes M1, and then it adds in all sorts of more exotic sort of deposits out there as well, besides your basic sort of bank deposits and some other stuff as well. And once my article's out there, people can see that. That basically I'm just taking those definitions from the Reserve Bank itself.
Right. So should we look?
So
wondering. Go ahead,
M0. Mate. Yeah. So M0, I use a chart. If you actually take it out to, I think 10 years is the one I used. If you can pop that up on the screen.
Yeah. Boom. Look at that.
Or maybe I used the 5. Yeah, that's pretty bad. If you look at the 5-year too, maybe that's what I actually used in my article. Look, you can see stuff's going on there. Basically, this looks highly interesting or unusual. And then I actually did.
Yeah, go ahead.
Oh, and I was going to say, then I also, because you can only show so much and do so much in an article, I jumped to M3 and kind of look at that over its entire period. The maximum sort of time frame a bit further down. Although the other graph is certainly that's scary enough, I suppose, but the other one probably looked a bit scarier, I suppose.
Let's just do that over 10 years, and you see that the big step up there. So you've got what you've got here in the M3 is you've got both the quantitative easing, but you've also got all of the credit creation by the banking system for home loans, and then that's creating new money.
Correct.
And so that new money gets taken out of the system when people pay back their mortgages. But what happens is because we've had all of this extra credit creation in this short period, it's massively expanded the money supply. And that can lead to inflation because people feel wealthier because they've got their houses are worth more, or they think that, or they get capital gains and then they can go spend them. So that there are clearly linkages between the money supply and then spending in the economy and prices. It's just that it's so difficult to trace those linkages, I think, and it makes it difficult for people to understand what's going on.
Yeah, look at as I try to point out in my article, the linkages are only difficult to literally trace. You can't literally trace dollar A goes here and then turns into price B over there. But I think it's a fairly well established. Like I said, I quote 3 different schools of thought, and they all agree inflation is and always was a monetary phenomenon. So it's coming from these artificial pumping up of the money supply. This is what we've probably mentioned this before in previous discussions. The Milton Friedman study that where he looked at this over centuries, I believe. So the point of the article is to make people aware that this is not some mysterious phenomenon. Now, prices obviously can go up. Particular prices go up for a whole bunch of different reasons. Obviously, they're particular demand and supply sort of situations. But money is such a huge influence on it. And particularly the quantity of money, because unlike obviously people will talk about inputs, like electricity, for instance. Electricity is used across the economy, definitely, and it's significant. But there's one thing that's used even more. That's exchanging money. Money itself. Money is involved in virtually every transaction except for minuscule amounts of barter, obviously. And that's minuscule. It really, that has very little impact. So money is the one thing that it is involved in every transaction. So therefore, it has a massive influence. So it's quantity vis-a-vis not its demand. And obviously, then you can bring in obviously more sophisticated ideas about inflationary or deflationary expectations. So in my article, just using some of Rothbard's analysis, he brings in inflationary expectations. So if people have low inflationary expectations, that can certainly keep the inflation at bay. It won't stop inflation as such, but it won't be as bad. Whereas when people start actually, expecting inflation, particularly like they did in the 1970s, then things can, really start to get ugly. And obviously they get far more ugly in countries like, Zimbabwe or Venezuela, or, looking back to Weimar Republic Germany. That's obviously when you're getting to the territory of hyperinflation. And people should be aware that our economies are not immune from hyperinflation. I'm not suggesting hyperinflation is coming, but it's not like we've solved the problem or something like that. We've just played with fire, and sometimes we've got lucky.
Yeah, Darren, I think hyperinflations occur when you've got the governments basically resorting to the printing press to pay their bills, don't they? Perhaps if we end up in extreme modern monetary theory, that's what ends up happening, isn't it? I mean, the governments are often at the core of those hyperinflations, aren't they? Is that right? And then they either print their own money or the central bank extends the credit to them, and then that gets in the system and drives up prices, and you end up in this hyperinflation.
Well, look, I think there's a few factors, obviously, but it's not a case of just it's only can happen in a banana republic. If you're suggesting that the Weimar Republic was not a banana republic, for instance, look, if you then sort of make everything worse with, obviously it's really a matter of degree, how much you're printing the money. And then, yes, throw in, obviously, if you're then throwing on top of it a whole bunch of other bad economic policies, obviously like the Venezuelas of this world or Zimbabwe's, then yeah. Again, I'm not predicting hyperinflation, but, and even if we don't get hyperinflation, if you look at, inflation is like compound interest, like even if it starts ticking down as a percentage, you haven't got rid of the other, the inflation is still there. You're constantly building on it unless you can literally deflate to the point where you can actually undo, the inflation of the past, which of course is not something we've seen, certainly not since the 1970s, but we probably actually haven't seen, the last time we've seen something like that is the 19th century where, literally prices are going down to the point that anytime we've had some inflation, the deflation that comes after it will actually get rid of that previous inflation, if you like.
Well, Darren, I want to chat about this because I'm not sure why it matters what the actual... If you take a snapshot in time, why does it matter what the actual prices and wages in nominal terms are, right? I mean, why does that actually matter? I mean, the inflation of the 70s and 80s, that happened over 40 to 50 years ago now. So, look, prices and wages across the economy have adjusted. Some people certainly lost money, right? I mean, inflation erodes savings. If you've got your money in the bank, your inflation is awful for you.
Wait a second. But if a bottle of Coke was 25 cents in the mid 70s, and it's like $5 now, that's inflation. That does make a difference.
Yeah, but average weekly earnings are way higher. Much higher now, aren't they, in nominal terms? Why are we worried about the actual nominal values?
Well, that's it. You have to. What it ends up being is this inflationary policy that all the central banks have, for the most part, is a race against time. So it's like income transferring. There's a certain group of wealthy people who can always stay ahead of it.
Yes.
Through their wages, their investments in equities, their property investments, and then there's a whole bunch of other people who cannot. So yes, you need nominal wages are literally the thing you actually get, and the nominal prices are literally the things you actually pay. So they are very important. Yes, you should, as economists, obviously, we should also then look at, okay, let's look at the inflation adjusted versions of those two things. Obviously, the sort of like income we're bringing in versus the costs that are going out. We need to see what that looks like, both nominally, but also inflation adjusted, because that tells us really, are we getting wealthier or are we not getting wealthier? So the 19th century, a century with very little inflation, the amount of wealth creation on a relative scale was far greater than the wealth creation in the 20th century because of all the inflationary policies. So it does make a difference. You need to you need to sort of factor in inflation and kind of sort of see how that's impacting both the incomes for people and their costs.
That's an interesting assertion, Darren. So, I mean, I would argue that hasn't the greatest period of wealth creation in terms of getting people out of absolute poverty, hasn't that been in the last 30 years or so? I mean, we've had extraordinary wealth creation. If you look at what's happening in China, I mean, maybe some parts of the Western world haven't been growing as fast as they did in the 30 glorious years following the Second World War, as they call them. But I mean, there's been wealth creation on a large scale in China and other parts of Asia that we should celebrate.
Yeah. Let me clarify. When I'm comparing the 19th century, I'm talking about, say, Australia or the U.S. are the countries that first developed in the late 1700s through to the mid 1800s. And when humanity first really, if you like, started to come out of poverty, and for good. And what I mean by poverty, I mean by literally, there are people at the beginning of the 19th century in the Western world who could starve to death, right? By the end of the 19th century, those people did not exist except for, small outlier cases, right? So then China, tried to copy that, obviously, I guess roughly from the 1980s, particularly through to the mid 2000s. And then we could have a totally different discussion on, what's been happening in China the past 15 years. I agree. Some of the great, the actually very, not completely, but largely positive pro-market reforms, if you like, in China at that time period, as you would expect, paid off great dividends just for the average person in China. So I don't disagree with that.
Absolutely. So Darren, could I ask, what are you arguing for, or do you have a view on what the appropriate policy settings are? I mean, you talked about the 19th century, okay? So that was a period that was characterized by, well, free trade, free movement of people, and the gold standard, and the balance of power. I think that's what Karl Polanyi talked about as the defining features of that Belle Epoque, of that period before the First World War, and everything just broke down the First World War. And we've never been able to get back to that type of system. I mean, I guess the view of a lot of economists now, modern economists, and even Milton Friedman, I think, was that you just couldn't go back to something like the gold standard. It's just not feasible in a modern economy. Are you arguing for a gold standard, or would you argue for something like what Milton Friedman argued for, the Federal Reserve, the central banks trying to keep the growth of the money supply at a K% growth rate or something like that? What are your thoughts on all of that?
Yeah, look, my article doesn't go into that, but I've certainly, in other articles and in other discussions, possibly even with you in the past, I am an advocate of the gold standard. Now, putting aside, it would take obviously some planning and, transition, and let's face it, like with any sort of serious free market reform, you may actually have to buy off some of the losers to, banks, and, banks in particular who, essentially been given exempt from what the laws used to call fraud, basically. What I say, basically the banks are allowed to actually lend out far more money than they actually have. And, through a lot of history, that was actually illegal. That was fraud. You actually couldn't do that. But in other words, if you only had $10 in your bank, how can you lend out 100? What? That's essentially what they do. It's legal. It's completely legal nowadays. So that's called fractional reserve banking. But so in essence, yes, under a gold standard, you would not see fractional reserve banking, except to the extent that some people would play loose with the laws, I suppose, and probably get sued. And probably their banks would have bank runs, if they were actually lending out way more money than they actually had. Not to say it would necessarily align 100% sort of thing, but the gold standard was very feasible previously, and the laws of economics haven't changed. if we may think we're very sophisticated and all that, but the laws of economics hasn't changed from the 19th century to now. They're still the same laws. And when you print money, you're going to cause, subject to the specifics of the demand for money and some inflationary expectations, you'll be causing inflation. And inflation is eroding wealth for the most part. Not equally so, which is why you have a system like this in the first place, because some people do very well out of this inflationary approach to monetary policy. So I could live as a start or a transition with the Friedman approach, but unfortunately, that's pie in the sky. Like the only time that you say, for instance, the Federal Reserve stuck within those bounds that economists like Milton Friedman suggested was Paul Volcker, one guy over the history of the Federal Reserve, from 1913 to the present. That doesn't fill me with confidence that central banks, can play by those rules. The better option is not to have a central bank. Now,
whoa, okay, so that's a controversial proposition. Tell me more about that, Darren. What?
Well, it's not controversial amongst sort of, not just Austrians, but there's quite a few other free market people. Okay, it may be controversial amongst people outside that group, but the central bank, is the problem. That's where the problem starts. And then you throw fractional reserve banking on top of it, but you wouldn't have fractional reserve banking unless you had central banks. And if you had a gold standard, you wouldn't have central banks nor fractional reserve banking. So when I'm saying, I think the gold standard is a far better, more economically efficient system, because it literally allows for greater actual wealth creation, not funny money to make it look like you're creating wealth, but actual wealth.
Yeah, I think we'll have to have another conversation on the gold standard, Darren, because I'd like to delve into it a bit more. I mean, my understanding, and I know there's debate about this, is that the gold standard period, didn't we end up with all of these banking crises and depressions? So when we had a big depression here in the 1890s in Australia, bank failures, and what about the 30s depression? Isn't there an argument? I think Barry Eichengreen made the argument that was caused by the gold standard that they had at the time, and it wasn't until FDR got America off that gold standard that the economy started recovering. Have you looked into that at all?
Yeah, look, Murray Rothbard took on both those issues in great detail. In fact, greater detail than the people that you've mentioned who make these claims, these opposite claims. Murray Rothbard looked very closely. That was actually, I believe, his PhD thesis. Was he looked at the various things that happened in the 19th century with bank runs and whatever else. He also looked at what happened in the 1930s as well. And actually, another person I believe are both kind of fans of, Robert Higgs. He also not so much was looking at monetary policy, but he did do a very close statistical analysis of that period and concluded that the U.S. didn't actually come out of the Depression until after World War II. It wasn't FDR's policies that got America out of the Depression. It was actually kind of Truman's much better policies, if you like, less interventionist policies in the wake of World War II that, finally got the U.S. out of the Great Depression. If you like a more technical economic sense, but not just a technical economic sense, people could then obviously feel it because people were not doing very well, obviously, as you would not expect during, a world war. Like economically, it's not usually a good time. No. So look, happy to sort of like point to the specific publications, that if you want to sort of make listeners aware of those publications. So there's a lot of sort of great economists, including Rothbard, Mises, Hayek, and a bunch of others who've certainly addressed, the counterclaims. And obviously, people have to rate it for themselves and decide what they think, who has the better argument. I think the better argument is in favor of the gold standard. And the problems of the 30s were certainly not the gold standard. I think it's been well documented by even sort of Chicago school economists at least, a lot of the bad microeconomic policies, the wage controls and the price controls and all that other stuff that really, made the depression stick, rather than it being something that lasted 6 months to a year. They extended it out to World War II and beyond through their bad, if you like, mismanagement of the economy in the U.S.
Right. Because you had there's obviously the stock market crash, and then there was a big another financial crisis in 31 or something. I mean, you had multiple issues with the depression. It wasn't just the stock market crash. There was also, then there were all the bank failures in the early 30s. And then the US went into another recession in, was it 37 or 38? And I think that's the point you were making, that
well, we've had actually more recessions, ups and downs, during the era of supposedly the stability that the central banks bring. They actually have brought more chaos to the economy than they've actually brought stability. If you compare it to, say, the 19th century, it's been far more ups and booms and busts and recessions and a depression, since the central banks than prior to the central banks.
Well, Friedman certainly blamed the Federal Reserve for the depression, didn't he? And then Ben Bernanke, in a famous speech in probably the early 2000s, a testimonial to Friedman, must have only been a few years before he died. Bernanke said that, look, yep, we're sorry, we did it. It's our fault, we won't do it again. So, yes. I'll put a link to that in the show notes.
Bernanke, he's the one who supposedly was a fan of Ayn Rand, was he not? Is that the right guy?
Was it? No, that's
oh, sorry,
that's
Alan
Greenspan.
Greenspan.
He was one of the devotees of Alan Greenspan. Alan Greenspan. He was part of that circle when she had the apartment in New York City, and she had people like Greenspan and I think Nathaniel Brandon, who was a psychologist. I was chatting about that with someone I met through Walter Block, who you connected me with, a psychologist I interviewed in a recent episode, and we were chatting about Ayn Rand, and he was a devotee of hers. Yeah, we'll have to chat about her sometime in the future. She's endlessly fascinating.
She is, and just because I'm a libertarian does not mean I agree with everything she's got to say, because I don't.
Was she necessarily a libertarian, or was she an objectivist? So there's this debate about, was she a libertarian or was she an objectivist?
Look, I mean, you know how these, even with the best intentions, these definitions are a little bit rubbery. Because I think she's broadly in the camp of libertarians, but there's all sorts of libertarians. So she's the objectivist stream or whatever branch of libertarianism. And apparently she did not I mentioned Murray Rothbard a couple of times. Apparently her and him didn't, see eye to eye and like each other all that much. So
was that over religion? Because Ayn Rand was famously an atheist.
Well, Murray Rothbard was an atheist, so no, it was over other things. Yeah, he was an atheist. Right. Okay. He wasn't a cranky and angry atheist, but he's but yeah, I mean, actually, and I wrote about Murray Rothbard and his views on Christianity, and his appreciation for its contributions to Western civilization and all that sort of stuff. So he was a guy who was actually very favorably disposed towards Christianity in particular, even though he's from a Jewish background, but he's secular. He's an atheist. So he was never. I don't think he was ever, someone who was, went to, was particularly religious in himself at any stage. So no, their sort of disagreements were over different things, and maybe it was just personality at the end of the day too. I mean, both actually Ayn Rand and Rothbard have separate reputations as being annoying. Probably for different. So maybe just two annoying people just can't get together. I don't know. It's. I mean, look, I'm annoying too, but I guess it sounds like Rothbard and Rand were on a different level of annoying, though.
I think that's probably right. Okay, Darren, we should start wrapping up. So basic message: central banks are behind inflation in your view, or they're not doing enough to to control the growth of money supply, and that's leading to inflation. And we're going to start seeing, we're starting to see accelerating inflation across Western economies, largely related to monetary policy, in your view. Is that, and quantitative easing, is that a fair summary? Please put it in your own words if you'd like.
Yeah, look, it's probably even more basic. It's just like, that rising prices have a cause, and they're not just other rising prices, right? So that cause is money supply, right? It's the main cause. It's not, to be fair, it's not the only cause, but it is the main cause, right? And inflation isn't the rise in prices. Inflation is that rise in the money supply itself, which then manifests itself as in, various, all sorts of prices rising, petrol, et cetera, food, also including not just consumer prices, but asset prices too. That's where it almost always shows up first. In particular, it almost always ends up in property and equities. Those two places. And as I don't think it was Walter Block, but it would have been another economist at the Mises Institute who has the skyscraper index. So apparently a lot of this funny money first goes into building super large skyscrapers, in particular trying to build the world's largest skyscraper. So there's maybe if I can find the link to that book, that's quite interesting. So that will cover, it's interesting because, I like skyscrapers, maybe not everybody does, but, he ties kind of the economics back to this practicality of, every time there's one of these funny money booms, someone's trying to build the world's tallest skyscraper.
Well,
and he's not saying it's a cause and he's not saying that it's guaranteed it's going to happen, but he says it correlates to an extent that, like, hey, you should pay attention to it.
So what are the famous examples? The Empire State Building, did that open up during the Depression in the 30s?
But it started during the first
the boom,
funny money period, the first funny money period for the Fed, which is the 1920s.
The Roaring '20s, and then is it the Petronas Towers in Kuala Lumpur? Is it where you've got did that precede the Asian financial crisis? I think you're right. There are a lot of really good examples along those lines. So
Skyscraper index is pretty good. It's not bad.
Skyscraper index. I'm going to have to. I'll have to invent my own and market it. I think it's a great idea, Darren. Good stuff. Okay. Any final words? Oh, go ahead.
Yeah. So that's basically it. I'm just trying to give a bit of an inflation 101 in an Australian context, like I did for an American context several months ago. I'm not saying I'm brilliant and I've discovered something new. No, I'm standing on the shoulders of giants who've already looked at this, and I'm just trying to get the message out there because, the AFRs and the Australians of this world, I'm not saying they're trying to cover it up, but they just won't explain these basic concepts that people really need to understand, because inflation is real and it affects your wealth. It affects, your ability to put a roof over your head, to feed yourself, all that sort of stuff, and to do it to the quality you would like to do it to.
Yeah, well, there's this temptation, this hope that this is only a transitory bout of inflation because of, the supply chain problems, or because of the disruption from COVID, what's happening in the global oil market, that sort of thing. And so there's, I guess, some people are hoping, maybe it isn't so bad. But because you've got those core inflation measures creeping up, I think the central banks will start to, increasingly they'll be concerned, and we will have to see policy interest rates increasing. I think I mentioned in my live stream last week, the Kiwi central bank's getting ahead of the curve on that. They've actually started to increase their policy rate, if I remember correctly.
So they're obviously not under the influence of modern monetary theory like the Federal Reserve is.
No, definitely not. Well, yeah.
Hopefully not.
MMT, yeah. Oh, wouldn't that be a disaster if it was fully implemented, as I think was discussed.
So yeah, look, inflation's only been temporary since 1974. So
Well, look, I think we'll have to Yeah, I've got a slightly different view. I mean, I think that what's happened in the past, that's a bygone now. I mean, there were people who certainly lost out from that high inflation back in the 70s and 80s. There's no doubt about that. But I think what matters is the rates occurring at the moment, because in my view, all the prices and wages in the economy, they just rise to a new levels in nominal terms, right? So it's the real values that matter. Okay. Now, yeah, you're right. I mean, people can lose out because of inflation, particularly if you've got savings and it's in a bank account and it's money, or if you're on a fixed income and you're a pensioner and you're getting a fixed amount of money in, and then you've got this huge bout of inflation and then your money's worth less in real terms. That's bad. I agree with you there.
Well, yeah, I mean, you look at it, if the average bank rate is well below 1% and inflation's at 3%, that's not good. That's, you're going backwards by 2+%.
Exactly, yeah, exactly. Okay, is this a good spot to end it, Darren? I've really enjoyed chatting with you as always.
Thank you.
Pleasure. Good on you.
Have a good day. Thank you.
You too.